Most new investors lose money quickly, often within their first year because they skip the most basic rule. Mark Cuban, a very rich businessman known from the TV show Shark Tank, saw this problem many times. He watched people jump into the stock market hoping to get rich fast. They would put their small savings or even borrowed money into companies they knew little about. They chased quick tips from friends or online posts. Most of the time, this ended badly. Their money disappeared, leaving them with nothing, or even worse, with more debt. Cuban knew there was a better way, a much safer path for anyone just starting out with their money. Mark Cuban built his massive wealth by understanding how money works, not just by being lucky. He started small, selling garbage bags door to door, and later built a big company called Broadcast.com, which he sold to Yahoo for billions of dollars. His journey taught him that smart money habits come first, even before thinking about buying company stocks. He saw that many new investors had it all wrong. They focused on picking the next big company stock, like trying to find a needle in a huge haystack. They felt excited by the idea of fast profits, but Cuban said this was like trying to run a marathon without first learning how to walk. It was a dangerous way to handle your hard-earned cash. He wanted to give beginners a simple, clear roadmap, something anyone could follow to avoid big mistakes. So, Mark Cuban gave a very simple yet powerful piece of advice for beginner stock investors. His first step was not about which company to buy or which market trend to follow. It was about cleaning up your own financial house first. He said, if you have credit card debt, pay it off. If you have any debt with high interest, pay it off. This was his main rule. He wanted people to understand that the interest rate you pay on credit cards is usually much higher than any money you might make from buying stocks. If you pay 20% interest on a credit card, you are losing money fast. It means for every $100 you owe, you pay an extra $20 each year just in interest. The stock market, on average, grows by about 7% to 10% a year. So, paying off a 20% debt is like getting a guaranteed 20% profit. It is a much smarter move than putting that money into stocks that might only give you 7% or could even lose money. His advice went step by step. First, list all your debts. Find out which ones have the highest interest rates. Usually, these are credit cards, small personal loans, or buy now, pay later plans. Then, make a strong plan to pay off these debts completely. For example, if you have $5,000 in credit card debt with a 22% interest rate, every dollar you put towards that debt saves you 22 cents each year. This is a very real, very certain saving. He wanted people to focus on this guaranteed profit first. After all high-interest debt was gone, his next step was to build an emergency fund. This meant saving enough money in a safe bank account to cover at least 6 months of your living costs. So if you needed $3,000 a month to pay for rent, food, and other things, you would aim to save $18,000. This fund was important to protect you if you lost your job or faced a big unexpected bill, like a car repair or a medical emergency. Only after these two crucial steps were done did Cuban say you should even think about buying company shares. Once all high-interest debt was gone and a solid emergency fund was built, Cuban said it was time for the next smart move. He advised people to invest in low-cost index funds, or ETFs. These are not single company stocks. Instead, an index fund holds many stocks at once. For example, an S&P 500 index fund holds small pieces of the 500 biggest companies in the United States. When you buy this fund, you are buying a tiny piece of all those companies. This makes your investment very spread out, so you're not betting on just one company to do well. If one company in the fund does badly, the other 499 companies can still do well, balancing it out. The costs to own these funds are very low, often less than 0.1% each year. This means more of your money stays invested and grows for you. Cuban stressed that you do not need to be a stock market expert to do this. You just need to be patient and keep putting money into these funds over many years. This simple approach lets you own a piece of the entire economy without the stress of picking individual winners or losers. However, many beginner investors often ignore this simple, smart advice. The biggest problem is that Cuban's method sounds slow and boring. It does not promise instant riches. There are no exciting stories of someone getting rich overnight by paying off credit card debt. Social media and financial news are often filled with stories of hot new company stocks, new cryptocurrencies, or quick trading strategies. These stories create a feeling that if you're not in on the next big thing, you will miss out. People see friends or online gurus showing off big, fast gains. This makes them feel impatient. They think that slowly paying off debt or putting money into a broad index fund is too simple or not powerful enough. They want the thrill, the excitement of making a quick profit. This desire for fast money often makes them skip the basic, proven steps and instead chase riskier investments. When beginners ignore Cuban's advice and chase quick gains, they often face a harsh reality. They put money into single companies that are popular at the moment without truly understanding the business. They buy into hype, not facts. Then, when the market changes or the company does not perform as expected, their money can disappear very fast. Many beginners pour their savings into one hot stock, only to see its value drop by half or more in a short time. They might even borrow money to buy these stocks, hoping for bigger profits, which just adds more risk. When losses happen, panic sets in. They might sell everything at a huge loss, or try to double down, putting more money into a falling stock, only to lose even more. This cycle of chasing, losing, and panicking can wipe out years of savings. It leaves them feeling defeated, thinking investing is too hard or only for lucky people. They learn the hard way that basic money rules exist for a very good reason. Today, Mark Cuban's simple advice still holds strong. It is not just about making money, but about building a strong, safe financial future. Paying off high-interest debt and building an emergency fund are the first and most important steps for anyone who wants to invest. Only after these foundations are in place should you consider putting money into the stock market. And even then, starting with broad, low-cost index funds is the smartest move. It is a slow and steady path, but it is a path that works for almost everyone over time. It avoids the traps of quick fixes and big risks. It is about understanding that true wealth is built with patience, discipline, and very simple, smart decisions about your money.